SpaceX is currently valued at $350 billion. It is difficult for the average retail investor to invest in private companies like SpaceX, XAI, Stripe, and Databricks, to name a few. Oftentimes, retail investors are locked out from these private companies and not able to realize the incredible gains in these private investments. In this video, I'll go over different ways to access companies like this and why it may not always be such a good idea. More and more companies are staying private for longer and not having an IPO. SpaceX valued at $350 billion, Stripe at $92 billion, OpenAI also at $92 billion, Databricks is valued at $75 billion. These are incredible gains that the average retail investor doesn't have access to. Google IPO'd in 2004 at a $23 billion valuation. Apple had an IPO back in 1980 at a $1.8 billion valuation. And Facebook IPO'd at just over $104 billion, which was the third largest IPO at the time. All of these companies are now over $1 trillion in valuation, meaning in the public markets, people had incredible gains if they held from IPO until now. The average retail investor is not able to tap into these private companies and reap the same rewards as these public companies. Typically, there are two ways an individual can invest in these private companies. They can either be a qualified investor or an accredited investor. A qualified investor has at least $5 million in investments. An accredited investor has a net worth exceeding $1 million, excluding their primary residency, and also has $200,000 as an income or $300,000 if they're filing jointly for at least the last 2 years and able to achieve that expected to achieve that in the coming year. Now let's talk about the options. How do you invest in companies like these? Option one would be finding a private placement. There may be a scenario where the company may offer their stock on the secondary market in what's called a private placement. You can either be part of an investment group and access these funds, or you can find a private placement broker and do the transactions directly with the company. You can also access these through private equity or venture capital funds. These involve pooling your investment with other investors and investing in private companies, startups, and other venture-backed securities. There's also secondary platforms like Forge or EquityZen, where the workers or shareholders at these companies will offer their stock directly to you. Again, you will have to be an accredited or qualified investor to access these offerings. There are crowdfunding platforms like SeedVest, Start Engine, or Republic that let you invest directly in companies with sometimes as little as $100. But these are high risk and often the companies may fail. There are many pros and cons to investing in these private companies. Number one, the most obvious, is the potential for a high return. These companies can grow rapidly and quickly, leading to an outsized return on your initial investment, quickly 10xing or maybe even more your investment. Number two is the access to innovation. You're investing directly oftentimes in the leading edge technology, seeing firsthand the changes that are occurring in our technology environment. Number three, this can also offer portfolio diversification, investing in markets that are not often publicly traded. Also, the investments here are not as liquid, leading to more static or steady returns in your portfolio. There's not the day-to-day volatility that you experience in the public markets. Now, the cons. And to go with the high growth potential is also the risk that your investment can go to zero. These are often long shots and can take a really long time to pan out, and it may not always be the case, meaning you could lose 100% of your investment. You also have liquidity risks. These investments are not trading day to day, but maybe once every couple of years. So it can take a long time to get your money out. you're either waiting for an IPO or some other exit opportunity. This could take 5, 7, or 10 plus years. You also have limited transparency. These companies do not have to offer quarterly guidance or financials like a publicly traded company does. These companies don't have to release financials, and so you don't have as much insight into what's going on operationally at the company. You also run the risk of dilution. As these companies grow, they'll need to raise additional capital, which means bringing in additional investors, meaning your additional investment can get diluted. Often these funds or investments can have high minimums and additional fees. It may require a large amount of capital to be invested up front to access these type of investments. Also, if you're investing through private equity or hedge funds, they can carry a high fee with them, sometimes a 2% management fee and also a 20% performance fee, which may be 20% on the profits over a certain benchmark of 7-8%. Again, diluting your return on investment. You also may incur transaction fees or administrative fees to hold these throughout the years. Again, it's good to know upfront what is your cost going to be to hold these securities. It may not be just a one-time transaction, but you'll have fund fees ongoing, maintenance fees ongoing, either quarterly or yearly, that you should account for. So, investing in private companies can offer the alluring prospect of high returns and access to this groundbreaking innovation, especially as more and more companies choose to stay private longer. While traditionally reserved for qualified or accredited investors, these private markets are becoming increasingly more accessible to the average retail investor. There's platforms available to the average investor to access some of these investments, but you should know ahead of time the risks and costs associated with investing in these private markets. Private investments are characterized by high illiquidity, limited transparency, and potential for dilution, as well as substantial minimum investments with long horizons. The possibility of losing 100% of your capital is a significant concern, and the array of fees can impact the overall return. Therefore, while the dream is still possible to invest in the next SpaceX, Apple, Nvidia, it's crucial for you to understand the risk and proceed with extreme caution. Recognize that these investments are fundamentally different than publicly traded stocks.